Market structure should be the foundation of your analysis. The first part of any trading plan is to establish which side of the market is in the commanding position, buyers or sellers, demand or supply. Today we'll talk about that, the market structure, and you'll learn how to read charts correctly. When reading market structure, you have to pay close attention to one thing on the chart, that is price. Price will tell you all you need to know. When price is moving influenced by supply and demand, this creates trends. A bull trend is depicted by higher highs and higher lows. The trend will continue in that direction until a lower low is printed by the asset price. The trend begins to show signs of weakness when it fails to print a higher high. A bear trend is the price action of lower lows and lower highs. The bear trend will continue to fall as long as lower highs continue to print. Once a higher high comes into the price, the trend will end. The sign that the trend may be reversing is when price begins to print higher lows or equal lows. A sideways trend is a trend that has equal highs and equal lows. Price trends in a range during this point of the market and is in consolidation. Markets can move in a period of consolidation for a long time. This trend is broken if the price breaks out from the top or bottom of the range. This could be the beginning of one of the first two trends. These are the obvious concepts regarding market structure. Now let's go deeper, and let me share the subtleties of market structure. The first principle is the most obvious one. For a market to be in an active cycle, its most recent structure must be one where price prints a high that breaks the previous high. This is the case of a bullish cycle. A down cycle will be established if the latest swing low in price breaks below the most recent low. In this hourly chart, you can clearly see the market in an upcycle phase on higher highs and higher lows. Several closes beyond last high, low to confirm that a bullish trend or upcycle is evolving in a healthy manner. Not only we need to see the high printed being higher than its previous high, but we also should expect at least several closes above that high or support area, as further evidence that the market is accepting and building value. Failure to print at least 2 or 3 closes above that high may translate into a false breakout, and while the move still holds its merit to qualify as a new high in the cycle, the quality of the leg is poor in nature. Find confirmation from higher time frames. You must avoid the trap of being short-sighted. When conducting your market structure analysis, it's all about finding confirmation from higher time frames down to your trading time frame. What this means is that if you are going to find an entry trigger on the hourly time frame, you should then understand what type of conditions are dominant in the immediately higher time frames. The most popular in this case would be the 4-hour and daily charts. A major mistake made by traders when analyzing market structure is allowing too much guessing play a role in their analysis. When analyzing the charts, how do you determine a relevant swing high, low? Is it this one, or this one? Which is more relevant? That's why you need to find a mechanical approach that will allow you to qualify a relevant swing high or swing low in the chart. Here's my general rule. If a swing low, high doesn't make it to at least the 50% retracement of its previous swing, I disregard that price movement as not relevant enough to represent a valid leg. I only want to focus on the creation of relevant and valid legs that will lead to new cycles and create in the process relevant levels of supports and resistances. Market don't always trend, and you'll come to the point in the market structure where the dominant trend starts drying up, maybe due to increased profit taking, removals of liquidity, intervention by market makers, or economic data-driven moves. While in an upcycle, the interpretation of the market structure is straightforward. You must determine when you've transitioned from a trend into a consolidation. Here's my method. Firstly, you must see a failed test of a valid high. Price is unable to break the recent high. Secondly, a failed test of the most recent swing low would confirm that we have entered a consolidation phase, which would last until the most recent valid high or low is broken, with at several closes above, below the level. In this context, don't forget that the consolidation is within the context of an upcycle. Until sellers manage to break and hold below the latest valid swing low, the strength remains to the upside. Another major sign that will help us determine the health of the cycle is the type of progress made by the dominant side in control of the cycle. You need to ask the following question: are the new legs in the cycle increasing or decreasing in magnitude? Here, despite having entered a period of consolidation, if we measure the latest swing high, if we measure its extension from the last low to the newly established high, we see that this is a bigger advance versus the previous up leg. This means that buyers are increasing their commitment on each new cycle high, greater demand imbalances. Therefore, this is yet another clue that the strength is to the upside. The magnitude is only half of the equation. The other one has to do with the velocity of the move or the speed. Was the new leg created after a fast and impulsive move? Or did price make a new low or high with the movement being sluggish, compressive and taking too long to form? A good rule of thumb is to count the approximate number of candles it took to achieve a new leg. In this case, you can see that the second leg was created with a lower number of candles, at a faster speed, so the cycle continues to prosper in a healthy manner. A reliable measure I have found to set targets when trading cycles is to measure the 100% Fibonacci projection from the most recent valid swing low to its high. In TradingView, you use this tool, trend-based fib extension. You need to join the lowest, the highest point and the low of the retracement or the pullback as the third point. For example, looking at this chart, we are in an up cycle. The first point to draw the Fibonacci extension would be at point A, the point B will be here and the third point will be here, at the low of the retracement. This will give you the 100% Fibonacci projection, and other probable resistance levels where the price may face resistance in the near future. If the cycle continues in the expected direction, you will start to appreciate the power and usefulness of these targets to consider taking profits or trailing stops, in the hope of a larger profit for your trade. In this example, notice how this target was reached almost to the pip before buyers took profit. Another important exercise you must perform is to draw the most immediate lines of support and resistance, at least 2 up and 2 down, based on a top-down analysis. I will make a separate video about this. They should be obvious to spot. Here you must take into account the number of times the area has been tested, ideally, minimum 2 times, the type of reaction away from this area, the stronger the more relevant, the time frame, the higher the time frame, the more significant the level is. Here, I've drawn the 2 most immediate levels of support and resistance on the daily and 4-hour charts. What this means is that if you are going to find trades on the hourly chart, you must be aware that once the price reaches these areas in the higher time frames, a potential reaction in the structure in your trading time frame, hourly in our example, may occur, so you must be aware by anticipating this potential outcome. Marking these levels in your chart allows you to know when to expect a potential reversal. If you've followed me this far, you now understand that a new cycle would be confirmed if we can break and have several closes outside the range. However, what if we break the current range but we are faced with another recent low immediately ahead? If the distance is relatively narrow, a safer approach is to wait until a breakout of the most distant level in that cluster of support areas, which would be several closes below this second level, to confirm the down cycle. Essentially, when this situation occurs, what you probably want to do is to expand the size of the range and wait for a resolution outside. So, how can you go about trading these cycles? First, assuming you are trading off the hourly chart, you want to make sure to trade also in line with at least the immediately higher time frame cycle, 4-hour, and ideally both daily and 4-hour. You also want to double check that the hourly market structure is trending several closes beyond the last valid swing low or high to confirm a new leg in the cycle. It's important that you then check the absence of nearby cluster levels from higher time frames or economic data releases that may disturb the structure. Observe both the magnitude and the speed on the creation of a new cycle. If we are in a healthy cycle with lower lows, for example, decent magnitude moves and no obstruction of higher time frame levels, pay attention to the 50% fib retracement of the correction. The 50% fib retracement a great location to start looking for trades based on your ideal entry technique. Some traders may prefer to set limit orders at this levels with a stop a few pips away from the most recent high. Others may prefer a confirmation trigger such as the break of a trend line, a particular pattern, flag, triangle, or a specific price action formation such as engulfing bars, pin bars. As for the target, I usually prefer to book partials at the last swing low and let the remaining quantity run till the 100% fib extension level. It's important to keep in mind that after booking partials, move your stop to your cost so that you are able to minimize your risk.